Hi, everyone. I'm Boyd Nash-Stacey. I'm a senior economist at Board, and I'm here to present the May 2026 macroeconomic outlook. Today, we're going to be talking about recessions, but before we dive into the content, I want to set the stage and really focus on consumer sentiment, which has gotten a lot of focus recently, and mostly from the negative perspective. So consumer sentiment is near all-time lows, which is also now being driven down further by the rise in oil prices due to the closing of the Strait of Hormuz. So a lot of the concerns are that is consumer sentiment an early signal or the canary in the proverbial coal mine for a recession, or is this noise? Because when we look at other indicators, like the number of persons unemployed per job opening, things are actually not looking that bad. But then there's also some other questions out there in terms of how immigration policy is going to impact labor supply and what will be the short and long-term effects of federal cost cutting. But ultimately, consumer sentiment can be volatile and ebb when the economy is flowing. So let's dive into the prospects for recession, something top of mind for many business leaders. So through some quantitative methods, we found that there's three essential factors in predicting economic recessions. And let me take a step back and explain what a recession is. So typically recessions are declared by the national MBER. And what they base this usually on is 2 consecutive quarters of negative GDP growth. So typically when we think about recessions, the focus is on gross domestic product growth. And what we found is there's 3 essential factors. And when we say essential, we want something that's good at both predicting recessions, but then also is good at not falsely predicting recessions or having false positive. In essence, predicting recession when there's no recession to come. And the 3 factors that we identified are the yield curve spread. In this case, it's the 10-year yield on a U.S. Treasury security divided by or subtracted from the 6-month. And this spread has been a very strong predictor of recessions throughout history, as you can see on the chart on the far left-hand side. In the middle, which is a good representation of household balance sheets, is the interest expense as a share of disposable income. Again, as households get pressured in terms of credit or the stock of credit on their balance sheets, this can lead to pullbacks in consumption of discretionary goods, which tends to drive recessions. So again, this is another strong indicator of recessions in the next 12 to 24 months. And the last one, which really speaks to consumers' kind of net worth, is cyclically adjusted price to earnings. This is really just a representation of equity markets that's normalized over time. So it makes it easier to compare periods, let's say 20, 30, 40, 50 years ago to the equity markets of today. So when we put it all together, we can see that currently the risk of recession over the next 12 to 24 months is only 12%. And so when we think about in the context of the average, this is really about average, meaning the economy is not too hot or too cold, or really on the precipice of tipping into recession. To give a little more perspective in terms of where we are, if we look back to 2022 and 2023, we're about 80% below those levels. And so just to give you some context for the economic environment at that point, that was characterized mainly by the Ukraine-Russia conflict and the pressures on the supply chains, but also in a tightening cycle at the Federal Reserve, where we saw interest rates rise from around 0% to 5% in little over 12 months. So again, acute economic pressures at that period of time where we're not in that scenario today. But one other important thing that I want to highlight with recessions is not all recessions are created equally, nor do they impact individuals, industries, or geographies equally. So if we look at the right-hand side, it gives us some perspective on how consumption can vary within a recession in terms of which segments are more or less impacted, and then over different business cycles. So for example, in 2008, the global financial crisis versus the pandemic. And you can see the pandemic, in obvious and maybe a good example would be gasoline consumption, right? Obviously, with the lockdowns being put in place in most of the country, obviously this was the category that was most impacted during that period of time. Conversely, if you look at other slowdowns or recessions, we can see that the what we call the lumpier or the bigger purchases like autos can be the most impacted during those periods of time. But another lens to look at recessions is to look across geographies. So if you look at a distinct group of large and economically diverse states, we can kind of get a sense of how these economies have fared over different business cycles. So for example, if we look in the 1980s, one of the main features of the US economy was the kind of the ebbing away from manufacturing and the struggles that were beginning to surface in the Rust Belt area. And you can see Ohio in this case was the most negatively impacted. So high oil prices, you have headwinds beyond just energy inputs within the sector. You can see that state suffered the most. Conversely, states like Texas and Florida, which not only were less exposed from an industry perspective, but also were benefiting from the population trends over that period of time, with many people moving to the Sun Belt region, were able to actually grow during that recession. So not all economies are in recession at the same time. If we fast forward to 2001 and the dot-com recession, you can see that New York being a financial hub and then California being the home to many of those companies associated with the dot-com boom and bust were the ones that were the most negatively impacted. And then finally, if we think about the 2008 global financial crisis, this mainly being a housing crisis kind of focused in the Sun Belt region, you can see Arizona, Florida being really the areas most negatively impacted, as well as New York being the financial capital again, and it being a financial shock. So again, outcomes can vary widely when we're thinking about the state impact. But to finish up, let's take a look at how states are faring today. And really the good news is that when we look at state by state GDP growth, in this case, this is the fourth quarter of 2015, the last available data point, the majority of states, and including the DC region, are growing. In fact, 49 out of the 51, if we include DC, are actually experiencing positive GDP growth. So again, no early signs of weaknesses across these states. What is interesting though is that the two areas that are contracting in terms of GDP growth, DC area and Maryland, are likely associated with some of the shutdown, the federal shutdowns that occurred in the latter part of the year, as well as some of the broader efforts to reduce the federal workforce. So I think the important takeaway here is that even though we are seeing some economic pain in the region, they're not symptoms that we would expect to spread to the broader economy. And so when we're thinking kind of where we are and where we're headed, although consumer sentiment has been weak, the current economic foundations are quite stable when we look at it from a regional perspective. So in this case, it might be a little bit of early signaling from consumer sentiment and not really fundamental to the prospects for the U.S. economy going forward. Thanks for taking the time for listening to the May Economic Outlook. My name is Boyd Nash-Stacey. Thanks again.